Hello there, opening great as always. Just want to shoot you a quick video. As always, let's get a little smarter. Let's get a little bit more competent. Because as Charlie Munger said, right, those who keep learning, improving, they keep rising in life. So let's get a little bit better, make smarter decisions. Because at the end of the day, better decisions lead to better outcomes, right? And better outcomes in the world of the stock market means more money, which makes our life better. Not just our own life. We build our own life, but we also might build life for people who are close to us, right? And be that positive lighthouse in a sense, right? So let's get smarter together. And we are getting into the bonus section, right? So here I have 25 kind of like a smaller snippets of interesting thoughts that I've, accumulated over the years. And that helped me to, get my portfolio to where it is today and build a proper framework for like a long-term investing mindset. So number one, your advantage as an investor does not come from following the advice of Wall Street experts. It comes from your own knowledge and understanding of specific companies, industries, and the world in its entirety. You can do better than the experts by being grounded and in tune with the society and its changes. What do I mean by that? Well, when you have some of those professional money managers, it's actually a tough position to be in, to be, blunt, right? It comes with lots of baggage, right? You have the clients, you have maybe your boss, of course, the market itself, different money managers. You're also getting the information, more from like that financial perspective, you might read the news, but it's also, being so deep in the heart of the system that you almost, cannot zoom out and understand the bigger picture, right? So as an individual investor, we are being accountable only to ourselves at the end of the day, right? And so let's use it to our advantage, right? Because we don't have, all of these constraints into which, many professional money managers do, right? So, do what you need to do, right? And develop your own system. Don't rely on someone, who's basically being in that, wheel and you might be just one out of million, right? Like if you abdicate that responsibility, put your money, for someone else to manage. Sure, there is a small number of very competent people, but for majority of money managers, it's just like one drop in a bucket, right? So, hey, doing your own thing, always the best. Number two, in past decades, the market's been dominated by three groups: professional investors, algorithms, and index funds. Contrary to what many people think, this actually makes it easier for individual investor to succeed. By not following the crowd and making your own investment decision, you have a good chance of outperforming the market. I wholeheartedly believe this. Because of course, index funds are basically a little bit making price discovery harder, right? And that combination of index funds and also algorithms are making the market especially volatile, right? And we can use that to our advantage once again, right? But we have to understand what's kind of going on, right? So the market's definitely being, quite all over the place. You've seen just like the past 5 years, let's say, the whole COVID crash and, then the mania and then 2022 bear market. Now, just recently in April, we had a quick, snapback dip because of the tariffs, right? All of the like a short-term madness of the market. Cool, there is always something happening. And we should use all of this to our advantage, right? So when there was that dip, a month or two ago, right, in April, that was the time, right? It was the time where to be a little bit more opportunistic. But for that, we have to know what we're doing, right? We have to be in tune with the market. We have to understand. Number three, owning stock makes you part owner of the company. Figure out what's going on in your company, right? You're an owner. And if you're just putting your money in, in some company and you don't even know what they're doing, especially into some, speculative company, you're gambling. That's there on this side, right? We want to be on this side. We want to be investing, which means we want to understand the business, understand the management team, understand where the company might be in 2-3 years. Not guess. We have to have educated estimate, right? Not just invest because someone said something, right, on YouTube, CNBC, right? Someone's talking about the stock. Well, sure, they might be right, but even if they are, and you rely on someone else's advice, you're just borrowing conviction, but it's not your own conviction, right? That's the place where you want to be. Understand enough that you're building your own conviction. Number 4, It is not possible to accurately predict changes in interest rates, the economy, or the stock market. It's best to ignore such forecasts and focus on the performance and prospects of the specific companies you have invested in. The world is so freaking complex. Macroeconomy, impossible to predict. There is just so much going on. So much, like if you are trying to basically predict economy, you're basically trying to predict, interest rates and unemployment, and also interest rates, not just in the US, but all of the other countries, because of course all of the other countries influence US, right? Then you have the, let's say trade deficit between the countries, right? There are just so many of these variables. Impossible, too complex of a system. However, when you focus on individual company, and let's make this super simple. You have Pepsi, for example, right? Making the drinks, super simple. You have the track record of the company, and based on the track record and analyst estimates, you can actually do a fairly decent job predicting what's going to happen in 2-3 years. Because you're looking at small number of variables, right? You're looking just at that one company, their product, how much are they making, how much are they selling. You're not trying to make sense of the whole world at once. You're just trying to make sense of that small domain, which is hard, but not impossible. Predicting market, impossible. Making forecasts about the company, reasonably possible, right? That's what you want to do. 5. The stock market in the United States has a long tradition, ease of access to information, stable legislative environment, and US companies are most of the time pinnacle of innovation, so investing in the US is one of the wisest options there is. I might get some pushback on this. Of course, there are exceptions, right? And, if you want to venture, into the foreign markets, not impossible. But once again, I don't want to make it harder for myself than it needs to be, right? So the US is the most simple in a sense, right? Long tradition, I think I've said enough, right? So why make it more complex than it needs to be? Simple. 6. The performance of a company's stock may not always match the success of the company's operations in the short term. However, in the long run, the success of the company and the success of its stock are directly linked. This disparity is what makes a successful investment, right? Short term, anything might happen, right? With the whole market, the company, short term, the stock price might be influenced by stories and the whole sector, moving and everything. But over short term, it really depends on how the company is. Revenue, net income. If the company is growing year in and year out, the stock price will eventually follow. Of course, now we get into more nuance, how much better is the company overvalued, undervalued. But to boil it down to the most simplistic, viewpoint, if you invest in a company and that company is going to be 10 times bigger 10 years from now, you will be very happy that you've invested and held the stock, right? So once again, simple, basic principles, right? That's what we are talking about here. 7. It's important to understand the investment you own and the reason for owning them. Someone's tweet with rocket emoji does not count, right? So that's almost similar to, what I've already mentioned today, right? We have to know what we have in our portfolio, why we own it, what's the thesis, right? And so we can also check, hey, is the thesis actually playing out? I think that this company is going to do X, Y, Z over the next 2-3 years. And let's check in 3 months, 6 months. Is that the case? Is it actually moving in the direction that I forecasted? Am I right? Or do I need to reevaluate? Have I made some mistake? Very much possible, especially if I'm newer to investing, right? So buy, but verify. 8. Owning stocks is like running a business. Don't get involved with more than you can handle. As a part-time investor, you should focus on a relatively small number of companies. Under 7 is more than enough before you reach 6 figures, and 12 companies can safely get you to 1 million, right? Portfolio management. Individual investor like you and me. 7 to 12 companies, definitely reasonable for most cases. Again, there is always a little asterisk and there is always a reason why maybe do things a little bit differently. But this is a good rule of thumb, right? We cannot keep, because also, if we have 7 to 12 companies in our portfolio, that probably means that we are following at least 30 companies closely from like a short list, right? to be able to identify those 7 to 12 companies. So if someone has like 30 stocks, is it 30 like random stocks, or is it 30 carefully chosen stocks? Because to choose 30 quality companies, you probably need to go through at least 100 contenders, right? Is that realistic? Probably not, right? So you want to kind of concentrate to your best ideas, right? So don't go overboard with those positions. And of course, not the other way, right? You definitely want to be a little bit more diversified and having, 1, 2, 3 companies, which I sometimes hear people having. So yeah, that's risky, just between the two of us. 9. Don't feel like you absolutely have to be invested. If there is no company that fits your criteria, you can just park your money in the bank for the time being, right? So especially, there are always opportunities somewhere, but that doesn't mean that you can see the opportunity at a given moment, right? So don't feel like you need to invest just to invest and put money to work, right? Sometimes it takes time to find some good companies, right? So if there is a period where maybe a month or two, there is nothing that's currently fits your criteria, maybe you have, existing portfolio and you need to add something to it, and maybe you see some company but it doesn't fit into your portfolio, which might also happen, right? Maybe you like the company but then you'll get your portfolio and you already have some similar company, right? You have maybe some, maybe you have Nvidia in your portfolio for a couple of years and it did great and you want to keep holding it. Well, why would I be buying AMD if I'm already, kind of satisfied with Nvidia, right? Either I'm like super confident in AMD and I want to swap it, but why would I have both? So there are all of these reasons why it's also sometimes makes sense to just, take a step back, wait. 10. Accounting is the language of business, and many portfolios were ruined by companies with weak balance sheet and poor cash flow quality, right? So balance sheet is super important for us, mostly to look for the red flags, right? Because there are many companies that have some, kind of holes in the boat, right? And we need to be able to identify those. Because that's usually how companies get ruined, right? By bad management, and that's usually hiding somewhere in the balance sheet, right? So you want to make sure that the company is in a good financial standing. Like there should be basically a list of criteria that we have for the companies that we are investing in, especially balance sheet, right? Financial health of the company. 11. Be cautious with trendy stocks in trendy industries. Candle that burns fast burns out. So yeah, be careful about, when there's a lot of chatter about some of the companies. Recently been, for example, with quantum stocks. There might be something to it, but to understand that you're very much in that, again, speculation territory, right? Because some of those companies, they basically have like a, revenue so minuscule, it becomes a binary bet, right? So lots of those, risky companies that people talk about because the stock price is rising, but is there actually something tangible, right? Because yeah, once again, like we have to understand what we are getting into. Is it investing or is it gambling? Only one leads to good results. 12. The smaller the company, the more proof of performance you should expect. This is a good point, right? Because sometimes, investing in smaller companies or kind of quote unquote riskier companies might not necessarily be risky, but it needs more work. Someone who's really competent investor and they want to look into something like, Pepsi or Meta or Google, those are mature companies, relatively simple business model at the end of the day, even though the scale is of course enormous, the business model is relatively simple. Competent investor can probably have a good idea about the company in a couple of hours. But if that same competent investor would look into some small growth company that's not well known, it might as well be a good opportunity, but that same person would need to spend maybe a solid day of work, maybe a couple days of work to have the good enough level of understanding, right? So sure, you can go there if you want, but understand what you're getting into, right? So sometimes again, it's about, sticking with some of those simple things. Simple. 13. If you're considering investing in an industry that is currently facing challenges, it's a good idea to choose companies that have a strong track record and are likely to weather the storm. Also, wait for some signs of revival. Graveyard is full of inventions that were made obsolete, right? So sometimes you have some, industries that are in a little bit of a decline, which might be temporary. But be careful about the turnarounds, right? Definitely a type of type of investment that we can make, but it's definitely a little bit on the trickier side, right? So there needs to be some proof that, hey, we need to be certain that we already passed that, point in the middle. 14. When you invest 1,000 in a stock, the most you can lose is that original amount. However, with patience and good investment, you have the potential to earn 10 or 50 times your original investment. So, investing, it's asymmetric risk reward inherently. If I invest 1,000, 10,000, 100,000, the most I can lose is that original amount. But I can make so much more, right? Because let's say, that 100,000 that I've put into Palantir, if I made a mistake, Palantir was a poor company, I could have lost 100K. It's 100K. But if I made the quote-unquote mistake of not investing in Palantir, I would basically lost all of those potential gains, right? Which is, over $1 million. So as long as we are investing in quality companies, not investing is so risky, right? Like people have it oftentimes backward, right? Investing is not necessarily risky. Not investing is risky. Because you're basically forfeiting all of those potential gains, which again can be quite massive, right? So yeah, you don't want to do something, you don't want to miss on those things. Yeah. 15. Long shots often do not pay. All returns need to be risk adjusted. So that again gets a little bit more into those speculative companies, right? Are we investing? Are we speculating? If you're veering too much into that speculation territory, you're putting yourself in unnecessary risk, right? So, and this is a tough one to try to explain, right? But you have to a little bit hone your sense of balance, right? Between some of these like super safe companies which provide very poor returns and risky companies which will, go into smoke. You want to be in that, sweet spot, right? For companies that, might appear a little bit risky, but by you understanding them, you'll do well. That's that sweet spot. 16. Individual investors can often find promising companies to invest in before professional investors in their own ivory towers on Wall Street can even notice them. Same idea, I've already mentioned this today, right? So, by having, open eyes, being more open to opportunities, seeing what people talked about, we can spot some of those trends early. And it's good as an individual investor to be a little bit more early, right? Before the Wall Street as the lemmings, kind of go and chase some of those companies. Palantir, again, is a great example, right? 17. Stock market dips are normal occurrence. Everyone expects snow in the Alps, as they should expect the market dip almost every year and drop every few years. So we have to be prepared for those. That happens every now and then. 3 out of 4 years in the market end up in the green, but 1 out of 4 ends up in the red, right? So, and we have to be prepared for both. We have to acknowledge that this is happening, be prepared for it, have some money prepared on the sidelines, use this as an opportunity. Tough to do when we are in it, when we are losing money, but we have to do it. 18. While anyone has the brain power to make the money in the stock market, not everyone has the stomach to handle the ups and downs. If you tend to sell off your investment during times of the market stress or uncertainty, it may be best to avoid stocks, right? Tough one, but yeah, there is a small number of people. You have to train yourself to have that mental fortitude. Not easy. 19. There will always be many concerns or uncertainties in the market, and it's important to focus on long-term investments and not get swayed by the short-term news or predictions. If you need to sell a stock, make sure to do that for solid reasons, such as decline in the company's financial health, rather than temporary market fluctuations or negative headlines, right? Focus on the business fundamentals, essential, not on the news. 20. There are always companies in the stock market whose success is not only recognized by investors and analysts. for every 10 to 15 companies you research, you might find one or two that makes you pleasantly surprised, right? So once again, that comes down to the decision-making criteria, right? There are lots of companies in the stock market, but we want to choose the top, let's say the top 10%, right? So yeah, it takes some time, it takes some work, and we have to have certain, certain standards for our companies. If you don't research companies before investing in their stock, you are essentially throwing darts blindfolded on a floating raft while standing on one foot. This approach is unlikely to lead to success. Yeah. I mean, do I need to repeat this one more time? We have to understand what we are buying. If that's not the case, if we just want to diversify for diversification's sake, tough luck. 22. When you own stocks in high quality companies, you have the luxury of being patient and waiting for your investment to pay off. Even if you missed out on an opportunity to invest in a great company early on, you may still benefit from owning it in the long term. On the contrary, options, which are financial contracts that give you the right but not the obligation to buy or sell a security at a specific price on or before a certain date, have a limited shelf life and the time is working against you, right? So focus on mastering stocks and long-term investing first. And only if that's covered, then you might want to play with options, not the other way around. Many people, promise options like a quick way to make money, but it's also a quick way to lose money, right? So long-term investing, it's the simpler, it's the easiest path for most people, and only if that's mastered, then you can move on. 23. If you're willing to invest your money but don't have time or interest to research specific companies, you can simply invest in an index fund, expect 6-7%, right? Sleep well at night. If you aim for 20% plus, you have to do the work. Simple. You have to decide who you are. Sure, for many people, just put money in the index fund, call it a day, nice and easy. Cool. But if you choose individual companies, no half measures, right? Do it properly, because that middle way, that's the debt, right? Because if you choose individual companies but do it haphazardly, then you're probably not going to do well, likely to lose money, right? So then it's better to just invest in an index fund. Of course, then be okay with 6-7%. In the long term, a group of carefully selected stocks will outperform bonds or savings. However, if the stocks are chosen haphazardly, keeping your money in safe might be safer than being a careless investor. Basically, same principle here, right? Stocks always outperform, but they have to be carefully chosen. And 25, investing is so amazing, mentally stimulating, but dangerous if you don't do your due diligence, right? So, this is something that I've sacrificed a good 8 years of my life so far, and I plan to continue doing this for many years in the future, and I'm enjoying every minute of it. But it was also tough, right? And it took me a long time to get it at least somewhat right. So let's do it, but let's do it well. So learn, improve, become better, make money. That's why we are here. Appreciate you all.